Did you know that the government can tax your Social Security? I know what you're thinking. That's like a double tax. It felt like a tax when they took it out of my paycheck, and then they tax it again when they give it back. Well, in today's video, I'm going to show you how to get your Social Security 100% tax-free. Hey folks, Dave McKnight here, best-selling author of The Power of Zero. In today's video, I'm going to show you what causes Social Security taxation and how you can avoid it altogether. For starters, we have to identify a term known as provisional income. That's the income the IRS tracks to determine if they're going to tax your Social Security. What counts as provisional income? Well, any 1099s from taxable investments count as provisional income. Maybe you sold a stock and had a capital gain, or maybe you received dividends or interest from a stock or bond. If that took place outside of a traditional retirement account, like an IRA or 401k, then it counts as provisional income. Next, any distributions at all from your tax-deferred retirement accounts count as provisional income. You take a distribution from your IRA, 401k, 403b, simple, you get the idea. That's also going to count as provisional income. Furthermore, if you're planning on receiving a pension in retirement, then that too will count as provisional income. Hey, maybe you're planning on working in retirement. Guess what? That also counts as provisional income. Now, this next one may surprise you. Even though municipal bond interest is free from federal tax, it too counts as provisional income. Finally, and this is really going to chap your hide, 1/2 of your Social Security counts as provisional income. You heard that right, 1/2 of your Social Security counts as provisional income. So the IRS adds all this provisional income up, and if it's a single person, it adds up to more than $25,000, or if it's a married couple, it adds up to more than $32,000, then guess what? Up to 50% of your Social Security can become taxable to you at your highest marginal tax bracket. I know what you're thinking. This sounds like a really raw deal, right? Well, it gets worse. If it's a single person, your provisional income adds up to more than $34,000, or if it's a married couple, it adds up to more than $44,000, then guess what? Up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. You heard that right. Okay, it's time for the Power of Zero question of the day. How does it make you feel knowing that your Social Security can be taxed? If it makes you madder than a hornet, go ahead and put "Dave, I'm madder than a hornet" in the comments section below. Let me put all this into perspective for you. Let's say that you and your spouse were planning on getting $40,000 of Social Security. Let's also say that you take $75,000 out of your IRA to meet your lifestyle needs in retirement. Let's figure out your provisional income amount. We take half of your Social Security, that's $20,000, and we add it to your $75,000 IRA distribution. That's a total of $95,000 of provisional income, which far exceeds the point where up to 85% of your Social Security could become taxable. Keep in mind that the standard deduction does not count against your provisional income level. So if your provisional income adds up to $95,000, then that's the number the IRS uses. So because you have $95,000 of provisional income, the IRS will now take 85% of your Social Security and pile it right on top of all your other income. For the purposes of this example, let's say you're in the 22% federal marginal tax bracket. So here's how we figure your tax. We multiply your Social Security amount, just $40,000, by 85%. That gives us $34,000. We then multiply that $34,000 by your marginal tax rate of 22%. That gives us $7,480. In other words, because you took so much money out of your IRA, you now have a $7,480 hole in your Social Security. And how do you think most people go about plugging that hole? By taking more money out of their IRAs and 401ks to compensate. So here's a math question for you. How much money would you have to take out of your IRA, pay that 22% federal tax to the IRS, and then be left over with $7,480 with which you can then plug the hole in your Social Security? Well, you have to use a special formula. You take the amount of money you need after tax and you divide it by 1 minus your marginal tax rate. In this case, we're dividing $7,480 by 0.78. That gives us $9,590. But what if tax rates double, like former Comptroller General of the federal government David Walker has predicted? What if that 22% becomes 44%? Then we'd have to divide $7,480 by 1 minus 0.44, which is 0.56. When we divide $7,480 by 0.56, we get $13,357. Folks, why do I even bring this stuff up? I bring it up because I've done the math 100 times in 100 different ways on 100 different clients, and this is what I've concluded. When your Social Security gets taxed, you run out of money 5 to 7 years faster than people who do not have their Social Security taxed. Why? Because the act of compensating for Social Security taxation forces you to spend down all your other assets that much faster. So now that we have established how your Social Security gets taxed and exactly how painful it can be, let's talk about how you can get your Social Security 100% tax-free. Well, this one is pretty easy. You just have to make sure that your provisional income as a single person is lower than $25,000 or as a married couple below $32,000. I know what you may be thinking. How am I supposed to survive in retirement if I'm not taking distributions from my tax-deferred retirement accounts? Well, here's the good news. When you take distributions from tax-free investments in retirement, it doesn't count as provisional income. It doesn't count against the thresholds which cause Social Security taxation. So that begs the question, which investment accounts are tax-free according to the IRS tax code? Well, it's a pretty short list. Roth IRAs, Roth 401ks, Roth conversions, and some kinds of permanent life insurance plans. So here's the key, and it really is this simple. If you pay for your lifestyle needs in retirement out of these tax-free vehicles, you can stay below the provisional income thresholds that cause Social Security taxation and get your Social Security 100% tax-free. And guess what? If you don't have to pay tax on your Social Security, you won't have to spend down all your other assets along the way, and your hard-earned retirement savings last longer. So what does this mean for those of you who have all your assets in your tax-deferred 401ks and IRAs? That means that you'll have to shift those dollars to tax-free by way of a Roth conversion. But here's the great news. We're currently at historically low tax rates, so the cost of executing that Roth conversion is just about as low as it's ever going to get. If you need some help shifting your assets into true tax-free investments so that your Social Security is 100% tax-free, head on over to davidmcknight.com and opt in for a complimentary strategy session. I'm happy to give you a hand. And don't forget to click like, subscribe, and the bell so you never miss a video, and feel free to ask questions or make comments in the comments section below. I answer every one of those comments personally. This is David McKnight. I'll see you on the next video.